Buenas tardes a todos.
Hello, good evening. Welcome to this 6th annual investor conference of Azvalor. It is 3 minutes past 6 of the 24th of March 2021, and we are now beginning this conference. Today we've learned from the governor of the Bank of Spain that the recovery of the Spanish economy is going to take a little bit longer. But the good news is that the governor also confirmed that as soon as European funds arrive, the recovery will speed up. This year's conference, as that of the previous 5 years, is going to follow the same pattern. There's going to be 30 minutes where we make presentations, followed by the very many questions that you have sent us, which we're going to be answering one by one. The only difference with the previous years is that this year, unfortunately, you can't join us face-to-face. We hope that next year the situation is different. We're holding this conference at a very symbolic venue because we don't normally come to this place to organize presentations. We normally come to this place to watch films. We are at Cnnv here in Madrid, a movie theater, and it's quite symbolic because in October last year, we joined the company as investors. So all of us are, owners of this cinema to a certain extent. We always say that you need to invest in shares that you know well. So organizing this 6th conference from one of those assets, I think is a good idea. Without further ado, I'm going to give the floor to Álvaro Guzmán de Lázaro, a founding member of the company. Welcome. Thank you, Beltran. Good evening, one and all. As we do every year, I am going to introduce the people joining me. Beltran Parajes, who introduced the conference. You already know him. He's a partner and sales manager of Azvalor. Sergio Fernandez Pacheco, who's next to me, is CFO, Human Resources Manager, and COO. Fernando and I are just 2 more managers in the Spanish scene, but I want to insist, as I do every year, that the team led by Beltran and Beltran himself are the best in their class in Spain. And in the case of Sergio, it's even more true, for whatever it's worth. And then there's my partner, Fernando Bernat. I am Álvaro Guzmán de Lázaro. So we're going to begin, as we do every year, by analyzing the results of our funds. In the slide, you can see the results of last year. The results were lower than the indices in 2021. This trend has reversed. Now we are above the indices, and from the beginning, as in the rest of the value world, these results, even if they are positive, we made 26% in the main fund, but since the beginning, they are not yet satisfactory for us, so we don't really feel proud of them. Fortunately, the next slide shows that there may be light at the end of the tunnel. So our funds have experienced the significant increases you can see in the slide, from the outset. After such significant decreases as the ones we experienced, I have to say that fundamentals are quite robust, and it's likely that in the next few years we are going to be exceeding the market, as the situation was at other historical times in 2003, in 2007, 2009. And then after that, we had very many very good years where we beat the market year on year. And my opinion is that, the situation is going to be similar on this occasion as well. Now, if we start by what can be expected from the world, and in principle, we are not crystal gazers. We want to be, we want to have our feet on the ground. But if we take the forecasts from Capital Economics, you can see that the world in general, after the plummeting in 2020, reasonably robust growth is expected for this year. It is to be noted that emerging economies in China will grow more than the rest of the world. This is something that might be significant for our portfolio because those are economies that will have greater population increases and more productivity. And these are real growth rates. So if inflation was higher, then the growth would be lower. But we don't really add value here. We add value in the selection of companies where we invest our money, and this is something that is going to be discussed by Fernando for each one of our funds. Thank you, Alvaro. I would like to begin by conveying a very clear message, namely that after rising 100% from minimum levels, our portfolios can double their value. So the potential that we have calculated is precisely 100%. As Alvaro said, after the plummeting of last year, there's no reason why, we can't have this about face, because it has happened in the past. Let's look at the different portfolios. First of all, Avalor Iberia. This is a cast of companies that meet the following qualitative features. They are leading companies. In many cases, they are number ones or they are amongst the leaders. These are companies which in Spain, we normally select from about 100 companies, and we know them very well because we have followed them for over 20 years, and we analyze them in depth every year. It's normally companies that are run or supervised by an owner. Most of them have a family behind them. And then there are also companies that have a very solid balance sheet with very little debt. And in the very few cases where there's some debt, the debt is supported by very solid assets, such as the case of Meliá. They have real estate assets, or To Protect, which has very liquid working capital with very clearly verifiable market value. And this is the most important slide with respect to our Iberian portfolio. This is the slide that compares price, which is the yellow line, which is the liquid value of the fund, and the value that we estimate, which is the blue line. So that's the key. That's the result of the analysis that we carry out. And I've explained it in the past, but it's always useful to remember it. We conduct an exhaustive analysis of the companies, and the analysis in each case ends up in an objective value, which is added up and weighted to calculate the final estimated value. This is a value that we believe in, and the market normally recognizes it, sometimes faster, sometimes more slowly, but this is something that for us is a kind of compass which reflects this 100% potential I was mentioning. And our endeavor is to try and improve that estimated value by creating value, finding new ideas, leveraging turnover of our portfolios, and in the long term, we normally achieve it. This doesn't mean that we always achieve it. On some occasions, the estimated value of the portfolio does fall, and and we reflect those movements when they happen, and we publish this information. For example, at the end of 2019 and beginning of 2020, the target value shrank a little. And there were several reasons. First of all, we decided to change some companies that had high potential but more risk, replace them by higher quality companies which were safer. So, we gave up some potential for more safety. And then COVID-19 also had an impact on some of our investments, such as Melia or others. But recently, we have gone back to value creation, and we are recovering our track of increasing the target value. So we're moving in the right direction. And this is the international portfolio. This is a portfolio which is in the first place highly diversified across sectors and across companies. And this is a message which we have introduced willfully. And it's a provocative message. And many of you might think that we are this may be a joke because 85% of the portfolio is invested in raw materials. But to be honest, raw materials are not a homogeneous universe whose fate is shared by all of them equally. That is not the case. And history shows that that is not the case. And we can see it at present because each of them have their own supply and demand conditions, and they can behave differently. For example, copper is nowadays at maximum levels, historical maximum levels, but natural gas in the United States is in the doldrums. So really, our portfolios are highly diversified. We have approximately 10 different sectors, including those that are not raw materials, and in a total of 70 different companies. So it's a highly diversified portfolio, which also brings together some of the best assets in the world and leading companies in the markets where they operate. Some of them are world leaders, others are regional leaders, but they're all very good companies, very good assets, and leaders in their own markets without any financial risk because they have practically no debt. 95% of companies in our portfolio have no debt, and only a small amount of them have a little bit more debt. They don't run any risk of disruption, especially from online and internet and digital, which has disrupted so many business models. And importantly, it's a very liquid portfolio. 90% of companies are tremendously liquid. And we have also sacrificed some potential because if we had included some smaller companies, we might have achieved a greater potential. But we did it this way in order to add robustness and so that we can all rest in peace. And what we achieved with this is that if for any reason there were people decided to withdraw their money, even if a lot of people did so, we could face up to that situation and without affecting the price of the shares or changing the makeup of the portfolio significantly. So, this is very important. So liquidity is a very important aspect, and this is our most liquid portfolio in our history.
And once again, the potential, here we have a comparison of potential and price. And at present, it is more than 100%, as we said at the beginning. And as an effect of COVID, for some time we saw a fall in that target value. Mainly, these are companies related to crude oil, that we'll talk about later, and some other companies. But recently, once again, we are been able to increase the target value, increasing value, and we're on the right track. And to create a long-term value, every time the blue line is at the top and pulls the yellow line up. And finally, Azvalor blue chips. It's the cherry picking of great companies. Most of the companies are in the International Iberian Fund. So some of the attributes that I mentioned for these are also applicable to the blue chips one. But that doesn't necessarily have to be so in the future. It could change. Now, the interesting thing about this fund is that it's very interesting in terms of managed volume and large and liquid companies. So it's a very agile fund and therefore very interesting because it can take better advantage of volatility and value creation that we achieve with the rotation of the companies in the fund. And finally, of course, the potential, which is slightly lower than that of the main funds, Iberia and International, but it is a fund with a very attractive potential as well. And now let me hand over to Alvaro. Now there's a notion that makes sense, which consists in saying that what goes up, necessarily, it isn't that it cannot go, still go up, but if one of our funds obtain a 100% revaluation, the logical thing is that it won't go up anymore. But there's something that is obvious, I think, for most of the people who are watching us, but perhaps others are unaware of this. And I'm going to apologize now because I'm going to describe it very briefly. If we imagine the fund is a share, let's say instead of having 60 shares in its portfolio, let's say we only had one share. You buy at 100 and goes up to 200, it went up 100%. If you sell that share and you buy another one, which went from 200 to 100, and the fund still has 100% of revaluation potential. And that is what we call rotation. As companies go up in value, we sell them, and we buy others that, in principle, we look for those that have fallen, although they're still worth a lot. And so if we haven't sold, of course, then things don't go up in a straight line. But if we sold, the potential can still be very interesting. And an example of those rotations, because we've done many, and we're just going to mention a few, but one example is Barrick Gold. We bought Barrick Gold in October 2016 at about $15. We bought more 2 years later at $10, and their share went up 150%. In November of last year, we sold part of it, not all the shares, part of the shares, and we started to buy shares from Cnnv. In October 2020, just when we were selling Barrick, we bought Cnnv, which had fallen from 60 euros per share to less than 20. So we saw something that went up 150%, and we buy something else that fell by 2/3 of its value. And so Cnnv then went up 125%. So it's as we would have sold Barrick at double the price. And the same thing we could say in the case of Freeport. We bought in dollars, it says 7 there. It reached $5 in March. We continued to buy, and then it gained value more than we expected. And they went from 5 to 35. We sold them at 26, and we bought Barrick that had fallen. So that is the game we usually play, and that allows us to create value and eliminate risk, because apart from creating value, when you sell something that has gained a lot of value and buys something that has lost value, well, that is what eliminates most of the risk. But now I'm going to hand over to Beltran again. I think that this is the image that defines the year 2020. Our friends Obelix and Asterix that we've known for more than 40 years have taught us for years that you needed to resist. Resistance is the name of the game. And with great challenges, they resisted. They withstood the threats of the Roman Empire. So the year 2020, for all those of you who are not having a good time and are suffering, this is what it is. And this is, I think, what has happened to us. We talk very often and we say that investments, sooner or later, are going to test us. And this has been a year of test, and a very demanding one indeed. And within the pain that we've suffered as society, there is also some room to think. And this reminds me of the year 2009 when I joined Alvaro and Fernando. I was very lucky. Funds had fallen more than 60%. And it reminds me what is happening now. And there's three fields here that I would like to talk about. The team of Azvalor. When you're under pressure, teams either break or come together. And I think that the fact that we believe in what we do, we've come out of this as one single man, united. And in terms of the second challenge, which is the portfolio, there were companies that fell tremendously in the first 4 months of 2020, and now these are the more coveted assets. How is it possible? A market that they don't want this, but then they really want it. So the fact that we maintain our confidence in these companies, that we did not rotate them when it was unnecessary, has pulled us out of that hole that many people thought we couldn't get out of. And thirdly, and perhaps most important, the base of Azvalor investors that has behaved as we thought they would, but when tested, people might react differently. But they're respecting whoever left because the circumstances have been demanding and difficult. But the truth is that the exceptional base of Azvalor clients has withstood, and the reward has been the return that we have achieved after 6 or 8 months. And I wanted to share this with you because it does remind me of what I lived in 2009, where these three factors occurred just in the same way. Regarding our activity, we always with the investor in the middle of everything. We tell our customers what is happening. We're close to our customers, and the year 2020 has been very difficult, but we have digitized as everybody else. And with these new digital mechanisms, that communication, being with all of you, has worked perfectly. What's more, some of us are getting to like this. And in 2020, we also had to think a little bit more. We roll out the Telegram channel with more than 1,000 people, and that forces us to think, study, draft, share. And I think there's a great deal of interest now in this channel. With regards to the numbers, new investors have joined us. 700, we welcome them and tell them that the yields they've obtained, because most joined as of March, they won't see again, or it will be very difficult to. With more than 100% return, that we won't see again. And normally we do what companies do that we have in our portfolio, 15%, for example. But not only have we got new clients, but there's been 2,500 new contributions. with regular contributions, which I think is one of the best ways to manage our excitement in investments. Not think whether this is the right time. For us, the right time is now, especially with a potential of an increase of 100%. But I know it's difficult. On Monday, you might feel optimistic. On Wednesday, you're pessimistic because we are affected by what surrounds us and the information we are bombarded with. We still collaborate with third parties, which, like us, are working in this field. Argent. If you're under 25 years of age, I would recommend that you join them. They have excellent plans. Recently, we were with their management, and their plans for 2021 and onwards are extraordinary. We continue to grow in that think tank that we created some time ago, a group of boutique asset managers. We exchange experiences, trying to improve. Recently, we published, but it was eclipsed by the pandemic, a paper where we talk about the role of boutique managers. Very interesting. It's on our webpage. And then we created a channel with the intention of improving thanks to your advice, and it's been very fruitful. And lastly, let me tell you about something that I feel very close to my heart, the publication of this book. In 2020, when we thought the world was ending, this book was published, a book of value, about value managers, value investment managers, people who are no longer with us. Others are at the peak of their professional career. Howard Marks, people whom we admire. Teen One that we've talked too much about in the year 2000. And this gentleman, Ronald Chan, has asked us to participate in the book. Chapter 8 is dedicated to what he calls a new generation of value managers that can replace the very famous ones that are retiring or that are no longer with us. And it's very inspiring. I recommend that you read this book. We've translated it into Spanish, and we're very pleased. I hope you like it if you have the chance to read it.
So, I am just going to summarize some aspects to do with the company's activity in 2020, and I will also take advantage of this opportunity to announce some improvements and some functions that will be made available in the next few days. So 2020 consolidated our growth path. We have processed over 11,000 transactions. Of them, 1.1 thousand were periodical and recurrent, and we believe that that is very useful, especially for investors who are more averse to volatility. So if you make periodic contributions, you mitigate this volatility, and at the same time, it allows you to automate your investment. So it's a very practical thing. The investor care team received over 5.6 thousand calls, and all of this activity has really put the platform to the test. And I've got to mention the high quality of service we've offered. We haven't had any single complaint. In terms of our website, it is still a very important critical channel to communicate with our investors, our potential investors. We have received over 1.2 million visits, 600,000 users, and our YouTube channel has had 144,000 viewings, and we've covered about 2 million minutes. In terms of digitation, which is something that we really lay great store by, because of its impact on the company's efficiency and the reduction of operational risk. We're still moving forward with digitization. Over 98% of our additional transactions that you carry out as investors are 100% digital. There's no print documentation anymore. Last year, we mentioned that we're going to make available to you the possibility to sign on through a digital channel, 100% digital, and this has been very helpful during the lockdown, where for many investors it was difficult to print the documentation and send it to us. So the process is now 100% digital. And as I was saying, I just want to mention a new service that we are going to offer, linked to the PSE2 directive, which is direct payment, and this is going to make it possible to make the order and make the bank transfer to the fund automatically in an integrated way with two different signatures, but I think that this will make the process, the contribution process easier. Now, from the regulatory point of view and also related to sustainability, on the 10th of March, a few days ago, the new regulation came into force on the dissemination of sustainability information in the financial sector. And this regulation bound us to different things. First of all, we had to have sustainability risk integration policy, and we just have to the idea is to organize or systematize the management of the different risks, especially corporate governance-related risks. Also, as another requirement of this directive, we have adapted our remuneration policy, especially the policy for those employees that may be at higher risk. And last but not least, I want to take advantage of this opportunity to remind you about the initiatives that we have had since 2015, which have an impact on different areas. Socially, we have the Avalor project. We also collaborate with this other organizations, social organizations, and also there's initiatives to improve the company's corporate governance. Along those lines, we have approved a variable remuneration system which forces all our employees to invest at least 25% of their bonus in Azvalor funds, and that percentage, in the case of our partners, is not 25, but is at least 50%. So that's a new policy which is there to align the interests of our employees with those of investors. So we'll give the floor to Javier, who's, as you know, responsible of the Avalor Balance Fund. The Avalor Managers' portfolio practically suffered no changes in 2020. The investments are the same, and the profitability reached minus 50%, and the liquidated value reached €51. But since then, the profitability has been of 115%, including a rise in 2021 of around 26%. The current value is €112, with profitability of 12% since the beginning, since the outset. Now, in any case, it's a short period of time to make any relevant comments, but it gives you an idea of the amount of overreaction that the market sometimes has, and how important it is as investors not to leave the boat in the middle of the storm, and how critical it is to invest with experienced managers that have had the experience of, such turbulent times as those of 2003, 2004, and those managers have again showed their skill and their resilience. And, the investment process has been very solid, very tough, and, the idea is to be able to tell the wheat from the chaff and, separate chaos from investment opportunities. If we delve into the portfolio, we can see that investments, all of them go in the right direction. The businesses are evolving favorably. It's a diversified portfolio at a geographic level, at a sectorial level that invests in companies of all sizes. It is true that there's a bias towards smaller and very small companies, which account for around 70% of the portfolio at present. And it's a, portfolio that doesn't really follow the indices, because, following the indices entails, in our opinion, a very high risk. In terms of valuation, the Azvalor manager's portfolio is, priced at very attractive prices, and the implicit or the underlying return, the annual underlying return generated by companies in this fund is of 17%, or in other words, in a 5-year period, we will have recovered our investment through the cash flow generated by companies, and we will still own the companies. And this implicit return of 17% is twice higher than the implicit return, for example, in the share market. Now, if we focus on the risk, well, we are very reassured with the companies we have and with the safety of that they contribute. There are a few risks that are relevant. For example, the pricing risk. We don't pay exorbitant prices for the companies we invest in. We shy away from that. And also the inflation risk. We want portfolios that would benefit from an inflationary environment. And we also want companies that are, of course, as resilient as possible. I want to thank you very much for your confidence in Advalor managers. If there's any question, do not hesitate to ask them. And be assured that we will treat this fund as if it was our own money, because in part it is. Thank you.
Yo voy a dar la entrada ahora.
I am going to give the floor to José María. Oh, it's a Avalor video. We are in Lodonga. This is the north of Uganda, on the border of some other country. And a few years ago, we built a primary school. We are supported by a group of nuns. This project was funded by Avalor. This is one of the many projects they fund throughout Africa. They have invested over 2 million euros in different projects, education, agriculture, etc. So there's 4 classrooms in this school. We are already fully booked. These are the 5th grade students who are going to go on to 6th grade very shortly. Unfortunately, because of the pandemic, the school had to be closed for a few months, so they've had fewer lessons than they should. So now they've got to speed up because they've got their exams very soon. This school was built in honor of Mrs. Moreno, who we really admire. So now José María will come and join us. Thank you very much, Alvaro. Thank you, all of you. First of all, I want to congratulate all the co-investors, those of you who were patient enough after the last conference, the most active co-investors, that you managed to double your value. And, we are here with all the asterisk characters, obelisks, etc. So, it's it's a story of resilience. But I want to mention that not all the merit belongs to the people I just mentioned. We've also received the help of our co-donors. These are people who are giving their lives in the field in Africa. And, you know, there's so much to do. And now with COVID, it's even worse. You know, we were telling them, look, you know, our products, you know, the values have gone down. They have plummeted. The value has plummeted. And they were saying, but what do you mean? Here in Africa, there's real problems. The problems are really serious. But, you know, this project you saw in the video is one of the very many projects. This school had 4 classrooms, and that was the 5th grade class. But we need more classrooms for children in 6th grade, 7th grade, etc. And we should also build a computer room, etc. And that requires, you know, those 4 classrooms requires only 45,000 euros, and that could be an Azvalor project for this year. These are educational projects. There's also healthcare projects. 30 kilometers away from this school, which is, you know, on the border with Sudan, South Sudan, there's a village where there's 250,000 South Sudan refugees. So a mobile clinic financed by Azvalor goes to that village several times a week, carrying drugs, medics and volunteers, nurses, even Spanish nurses. So we are caring for 7,000 beneficiaries every year with 20,000 euros. So it's 3 euros per beneficiary. That's a difference, and that can be the difference between life and death. And there's also agricultural projects. For example, in that refugee camp, there's an agricultural project that was not implemented by Azvalor, but it's amongst the refugees that we assist. You know, they're receiving rations, which are, so in those programs, they receive 50% of the rations that they used to get in the past. So now we're giving them the tools to set up their own farms and grow their own food. And so the rain season is coming, and they need 6,000 euros. We are talking about 2 euros per beneficiary. We're also helping people with disabilities. It's 40 people. Now it's 37 because 3 died in 2020. But that's all that's not all that we do. We do many other things. But COVID, in Africa, people don't really know what COVID is. The pyramid is really flat in Africa, with a few exceptions, and with all that we've lived through. In Africa, very few people go beyond age 70, and they find themselves with lockdown and a series of economic problems, they are really very resilient people. They've got wars, they've got AIDS, they've got Ebola, they've got all sorts of malaria. So they don't know so much about COVID, but staying away from school for a year, or, you know, or children that have to start working because they used to eat at school, and, you know, if they can't eat anymore, you know, we need to address all of those situations. And now our liquid values have gone up, which is very good news. But we also need to increase our contributions to Azvalor, because we need to be thankful. So it's like when you go to the casino and you give a few coins or a few chips to the croupier. So if you have 1,000 euros in the investment, you could contribute 100 euros. Or if you have 1 million, you could contribute 1,000. So we need to do something big and share our happiness. Thank you very much.
Muchas gracias, José María.
Thank you very much, José María. If this were live, you would have received an applause. You usually do in our meetings when you talk about your projects, and rightly so. So I'm going to finish so that we can open the Q&A, and let me finish with 3 or 4 remarks. We already said it, but let me repeat it. We have a base of customers, you, who are exceptional. Exceptional because you understand what we do. Exceptional because you can stand volatility, some more than others. And these are 2 qualities without which we could not do this business. We have a team of professionals, very much consolidated. Beltran already talked about it, and he did it really well, so I have nothing more to add. Each one in their responsibilities, human resources, etc., know what they're doing, and they've been tested. Our portfolio is very attractive. Despite the increase, it still has a huge potential, and it is a portfolio that we know well. Although we've rotated it on 2 assets twice. So the fact that we know the portfolio well, we know the companies well, does eliminate part of the risk. And there's a historical basis to think about good returns, and for several years to come. I said it, and I repeat it now. With the fundamentals we have today, the logical thing would be to outperform the market for several years in a row. And now we can open the Q&A. Fine. So why don't we start with our questions? We've received lots of questions. You can still send us your questions. Sorry, I thought I had left something there. Okay, please do send your questions. When he said if this were live, it is live because it's 6:49. It is live, but what he meant, Alvaro meant, was that we had no audience. So, Fernando, Sergio, why don't we begin with the questions? We've received, as I say, lots, and let's try to answer all questions. The initial Azvalor portfolio is quite different to the last one you left in Vestinver. With a change in name, have you changed your philosophy? And the second question is, when do we think funds will go up? Well, the first one is, Beltran, if the portfolio is different, has our philosophy changed? Okay. Well, no. After 23 years doing the same thing, we have not changed our philosophy. The investment, the way we understand it, is a process where you need some fixed anchors. Otherwise, you go astray. So these anchors are very important. How much you pay for a business is very important. And if you pay more for a business, there's less future expected return. Another important thing as well is that you need to invest in what you know. And what you don't know, you should not invest in, because the market always tests you. So I don't think we have changed. Now, it is true that a characteristic of the world of investments is that we evolve every day because reality changes and you need to adapt, and we evolve. But this cornerstone hasn't changed. And our idea is not to change it. And I think the question was also if the portfolio changes. Well, yes, because prices change every day, and the portfolios are different. And then the question of when funds are going to go up. Let me give you an example with a specific share. We bought Camel 4 years ago at about 9-10 euros, and for 4 years, nothing went up. And suddenly, from and multiplied by 3 or 4 from the low levels it reached in March. So you're invested in a company 4 years, nothing happens, and in 6 or 8 months you get the return of 4 years. Well, if it were 5 years, it's 15% a year or slightly more. But there are other companies, for example, Bosai, where we bought, and as soon as we bought, it started to go up. We bought at about 10 euros. Now it's 30, a year and a half after we bought. And sometimes you're managing a company and you're studying it. You haven't finished your study yet, and you don't have time to buy it. So when are funds going to go up? I don't know, but I repeat what I said earlier. Based on our fundamentals, the logical thing, as we've seen on other occasions, is that we get value several years in a row. I don't think we're very convincing because they always ask this question ever since we started. Azvalor, they ask us, the investors ask, what happened? Have you changed? And I want to insist that nothing has changed. It is true that at the end of the period of Bestinver, we did not have cyclical companies because circumstances were different and other companies were cheap. But we invested in steel companies, we invested in paper company, chemical companies, construction companies, or these are cyclical businesses. And they're not the wonderful businesses that we had with 13 or 14%. But we've always bought cheap. And the opportunity to buy cheap sometimes comes wearing a suit and sometimes a sports jacket. Another investor asked, I'm the typical investor who started with you, invest in VER in 2002. Then I went to Azvalor. So I have investments in value investors, investments. But what do you think are the differences between value managers and you? Or why is Azvalor different from other value managers? Well, first of all, I think it's a very interesting idea to give that long-term perspective. This is a long-term thing, very long-term. The longer the term, the better. Although in the past few years, we haven't been able to beat the indexes. But now we are convinced that now we have and we will continue to do so in very long timelines. And in terms of differences with other value managers, I don't think it is us who should say this, but there are many things that we have in common. But what is important is to mention the differences with the largest managers, because there the focus is quite different. Our focus is return, because our money is at stake, the money of our friends, family, and yours, whilst in those companies, they focus more on the business. And very often you will have seen that they give public growth targets as trying to find the virtue in size. We, on the contrary, and in this I do think we are quite unique, we have made a public commitment from the beginning to limit the size. So the focus is completely different. I remind you that there is a premise where there's a conflict between size and return, and we have opted for return. And that, I think, is the most important difference between us. There are some asset managers, small ones, and they're value managers, but they have also some advantages. And I've been very respectful with To Value or others who are people who do things really well, and they're smaller than we are. And perhaps they have another or more investment opportunities than us. So yes, there are these smaller ones that I'm looking at. Perhaps we can talk about them next year, and I'm sure they're very interesting. Okay, the next question. We are congratulated by the good work in the past year. But this person is not very optimistic with monetary policies, and this might have a negative impact on the investment ecosystem. If we have another strategy apart from the recurrent investment in gold, foreseeing high inflation in the coming years, given the monetary policies of central banks and the monetary policy that might be followed by the new U.S. president. So monetary policy of Mr. Biden basically is the question. Okay, thank you for congratulating us for our good work. And regarding inflationist policies, they're very risky in general. And perhaps it's a bit optimistic to think that everything will go well. What we do is to look for value in the middle of a pandemic or in inflation periods. The fact that we're here in Cnnv in this movie theater is a result of the pandemic. And movie theaters were closed, the value fell, and we bought. So sometimes there will be macro circumstances that you can foresee, others you cannot, but we shouldn't wait for monetary policies to always be good. You can wait forever. And more specifically, he asks about Biden's policy. Well, the answer is that we don't know, but we can know what we need to focus on to determine whether that policy will take us to disaster or not. We like to look at the level of public spending and how it is financed, if it is financed with taxes or otherwise in more creative manners. I leave it there. I can't say more. Another question, what percentage do the founding partners have invested in their funds? Sergio, you should answer that. Well, yes, we've been asked this very often. The partners have all our net worth invested in the funds. And also our parents, our sisters, brothers, our relatives. The joint investment between partners, we are the greatest investors by far in our funds. And I think it's only logical. There's something that we say often, and I like. You have to say what you do and do what you say. And in our case, we don't offer products to our investors that we don't think are good enough for us. So we offer the funds where we ourselves invest. And it's only logical that we invest our money in these funds. This is natural. And as I said earlier, we have taken a step further, and we're going to have an incentives policy that will formalize this. At least 25% of variable incentives, variable pay of the partners will be invested in the fund. We think that that is a very good idea.
Would you like to add anything about the percentage? Well, I have 100% of my financial investment is in our funds. I have most of it, but I do have, like 2% in some other smaller fund managers. Right, there's another question. The balance of the first 5 years, what would you do differently if you had to start all over again? Well, a 5-year balance, well, it's been 5 years where we've had all sorts of things happening, things that never happened before. A fall of 50% in the liquid value, which had never occurred. But when you balance things out in the first, well, companies, normally in the first 2 or 3 years, some of them go bust. We have not gone bust, and you've got to consider that we've lived through a very bad pandemic, and we had the worst crisis in value investing in history. Value investing had never done so badly. So I think that we did quite a good job. Of course, there were mistakes. I'm sure there were mistakes, and what we need to do is you can't say that you're perfect. That's two presumptions. You just have to ask our wives. But of course, I would change a few things. I'm sure I would. I don't know whether Fernando can think of something specific. In my case, for example, we've changed things with respect to the size of our models. We've changed things about the length of our meetings. We've changed the time we devote to email. So we've changed a few things, and I'm sure that we will change others, because changing is improving. Now, in the way we invest, we haven't changed anything, and we shouldn't change anything, because our policy has worked reasonably well in the last few years. If I had the opportunity to do something differently, perhaps at the peak of the pandemic, at the height of the pandemic, in March or April, we could have been more persuasive with some customers. We didn't have too many customers withdrawing their investments, but we did have a few. So perhaps our mistake was not to try and discourage those investors from withdrawing their funds. And I'm not criticizing the sales team, because I'm sure that Berlan, Andrea, and Ignacio, and Manu, and Samu did all they could. But people were at home. They were quaking in their shoes, because of the pandemic, and it was tough. But if I could change something, I could have perhaps coached them a little or supported them a little, because in the last 50% fall we had between 2007 and 2009, I said it once in the past, we were really upset at so many people selling out. But of course, on the other hand, it's understandable. And so the first thing is, to thank all three of you, and of course Fernando. I see him more often than I see my wife. I also want to thank Beltran for doing your job so well. Also Sergio, who does so many things in this company. I also wanted to thank our team. Javier Oduna, Javier Campos, the two Felipes, Victor, and Michael, and Paul, who are perhaps closer to us in our management work, and also our trading team, who start work at 7 in the morning and they go on until 10 at night. And I also want to thank Rosalia, who's been with us for so many years. And I would also like to thank, and this is perhaps too much for a session like this, but I would also like to thank Jose Maria, who with Avalor does so much for us, and he is really doing very important work. I also want to thank my brothers. My father is very ill, and it's thanks to them that I can, do my work more or less normally. I also want to thank my wife for supporting me, and I also want to thank my mother, who I'm sure is in heaven, and she has done her share to help us. And I also want to thank the boss. Thank you very much for this long. I'm sorry, I want to apologize for this long-winded answer. And the next question is the following. Most of the portfolio is made up of raw material companies which by nature are cyclical. What will be the investment strategy once we reach the high part of the cycle? Perhaps you will have to look for alternatives. Wouldn't it be easier to invest in anti-cyclical consumer goods companies and keep them forever? Fernando, would you like to take this question? Well, the strategy when raw material companies bear fruit and before they reach the target price, what you should do is sell out. In the case of raw materials, this is not an exception. We are completely agnostic. We did it in 2016 when there were companies such as Antofagasta where we reached over 7%. It went to 9 or 10 pounds, and we sold out and we reinvested in companies that had nothing to do with raw materials, such as JC Decaux or Vivendi, and we're doing it back again now. Last year, we had investments, very significant investments in mining companies such as Freeport, First Quantum, and Grupo Mexico, and now we have nothing. We've sold all those positions because, the price had risen a lot. And then they kept on rising, but we had sold everything, and we have reinvested the money in Connectives, and we're also reinvesting in other things. That is a constant for us, and we do it all the time. Alternatives are something that we look at every single day. Also, to improve our current portfolio as much as possible, try to hone it as much as possible, incorporating new ideas, etc. Why not buy more stable companies and anti-cyclical consumer goods companies? Well, it could be easier. I think that good investments are never easy. Easy investments are not normally good. Anybody can buy a flat in the best area of Madrid, but you have a stable investment, but you're not going to make huge profits. It's very difficult to achieve good profits. So it's not as simple as all that. We have had very good companies, wonderful franchises, for example, in 2008 and 2009, but we bought them in the midst of a panic. Everybody was fleeing because, everybody thought that the world would come to an end, and no company was devoid of risk. So it's not easy to buy good companies at a cheap price. That doesn't exist. Mr. Buffett, some of the wonderful companies that he bought them when they were in the doldrums. American Express, for example, he bought it at a time of crisis. Or Geico, for example, which was competing with huge companies. Now it is a good company, but when Mr. Buffett bought it, it wasn't. I don't know whether you can think of more examples, but investments can never be comfortable, but our investors, and we have had two very clear periods where the feeling I have, or from what I'm told by investors, is that things looked easy, right? From 2003 to 2007, it was easy to follow us. And then after the crisis of 2009, it was easy to follow us again. But But in 2003, we had a very significant fall of 50%, and in 2008, we had a fall of 63%. So after a fall, everything is easy. So this has happened to us in the past, and this feeling of safety was associated to the companies we were invested in, but I think it should have been associated to the price at which we bought our stake. People that have investments in active management securities do so because we want to beat the reference indices. Perhaps this may not happen in 2 or 3 years, but then after that, arguments just are not believable anymore. So how many years do you think that we should wait for active managers or for active management to actually go north? Thank you very much for your question. It's a question shared by many people. At the end of the day, how long is it? How long do we need for things to go north? Well, there is a slide by Mr. Buffett. I don't know whether it's available. Yeah, there you have it. I can't see very well, but it's a slide that shows from 1999, there have been other periods before where the index was not beaten either. But and he is the best investor of all time. So there were 3 or 4 years where he couldn't beat the index. So not beating the index for 3 or 4 years is something reasonably normal, even for Warren Buffett. And this is how long we have failed to beat it. So we are within normal ranges. And after this rise from minimum levels where we have beaten the index, makes us believe that we are on the right path. The slide mentioned by Fernando that showed the price and value, the difference between price and value is a calculation that we have done, and this is a fruit that we still haven't harvested. So we've had the same situation with several companies, and after a fall in value at halfway 2016 we were at 160 and we had been at 60. So after, I think that is a good example. People say that in value investment time plays in our favor. Isn't it contradictory to invest in funds that may be affected by a technological disruption? What would you say?
Well, I think it's actually two different things. That time is in our favor means that if a company makes 20 and it's worth 100 after 3 years, when we're paid dividends, so at the end we get 60. And when you get 60 in 3 years, that company doesn't last too long at 100. So as time goes by, there's that company usually, the price increases. And that's what we mean when we say that time is in our favor. But what it says then is that in case of technological disruption, and in that case, the company that is making 20 and is worth 100, and now is making, instead of 20, it's making 2. So this co-investor is right when he asks this question. And it's what we do. We try to avoid the value trap and analyze companies properly. So it's two different things. Now, disruption in our portfolio, I find it very difficult. I wouldn't dare say it's impossible, but it's very difficult to replace copper or uranium. Very difficult. Very difficult to replace gold. Oil. Well, perhaps there are people who think it's easier to replace oil. I don't know. But with everyone against it, the weight of hydrocarbons in the consumption of primary energy in the world has only fallen by a few points in the past 30 to 40 years. We always say that the Stone Age is over, but we consume more stones than ever because there are more people in the planet, and the oil consumption per capita will fall, but total consumption will continue to increase. Perhaps it won't increase at the rate it has in the past 10 or 12 years, like 99%. I don't think it's going to go up at that rate, but it will go up 500, 600 barrels a day. And so I don't think so. I don't think our portfolio runs the risk of a technological disruption. In the case of oil, that might be the only one where you could have a doubt if whether in the mid or long term electric cars can replace the use of oil. Well, we are invested in companies at 6 times profit in oil companies, and it's very difficult in 6 years for the electric cars to replace the consumption of oil. So there are many papers that calculated that if every single car in the EU were electric, it would take about 25 years, and that would mean a reduction of about 8 million barrels a day. But it turns out that in those 25 years, India alone, its consumption grows by the same amount, so or more, much more. So there are more questions than answers with electric cars. Well, questions in the sense that it might affect so much the demand for oil. And they're listed, these companies are at very attractive prices. I think it's interesting to add that in terms of the electric car, it's not a technological disruption of the market that makes something more efficient or that better meets a need there was. No, this is a nuance. This is a policy. It is not more efficient, nor does it do things better than the traditional car, but it's a respectable policy, of course, to care for the environment. So it doesn't respond to market forces like internet, when it makes your life much easier, or Ryanair, when it allows you to fly at a much lower price. So it's costing us money to become green. It's very costly. So these are forces that take their time. If we think about coal, for decades, coal is losing against other alternatives like renewable energies or gas, but the world coal market until very recently continued to grow by 1% a year. And now it's fallen, but very little, really. But so these things take time. It's a different timing. And technological disruption is different. It allows you to do something cheaper and better. This is not the case. Well, technology is not something, a force of the market. Because there was horses and then cars that replaced carriages pulled by horses. And that does change your life. So these technologies do change your life. But when you said that electric cars have behind it the states with subsidies, I thought of something else. Taxes. The taxes that states collect from oil, if electric cars, become abundant, they will have to tax them. So perhaps they won't be so convenient. Electric cars have batteries that last 20 or 25 years, but they don't last much more than 25 years. And they weigh 200 or 300 kilograms, those batteries for those electric cars. So we'll have to do something about that waste, those batteries. How do we dispose of them afterwards? So perhaps what the state wants to fix it, and then the electric car has as many disadvantages perhaps as oil. Who knows? And the next question is, it says, the last time that the PER went up in the year 2000, 2009, that was just before a very important financial crisis when price-earnings ratio goes up so much. What can you say about that? Well, yes, we've been warning people about this for some time. The indexes, particularly in the American market, are very expensive. This person mentions the PER of Schiller, which is adjusted by the cycle and inflation, a PER adjusted by a 10-year cycle and inflation. But however you look at it from the aggregate point of view, it is a market that is expensive. If you use the famous Buffett indicator or a price book value or sales price, from every single point of view, it's expensive. And if you look like we do company after company, you realize that it's very difficult to find cheap companies in general in the indexes and in the American market. So valuations, expensive. And if there's going to be a financial crisis because PER is very high, well, for many years, sometimes the market goes up, down, and it remains as it was after some years. It's unpredictable, but we find it very difficult for investors in Great Western indexes and in the American bourse can get a good yield in the next few years. Along those lines, somebody is asking, when will the stock exchanges be hit? Right now, it's better not to work and put everything in the stock exchange. That is not normal. We're very happy with the recoveries of the recent net asset value recovery, but this rally will end soon and there will be corrections, noticeable ones. Well, I don't know. As Fernando said, the indexes are high, but I don't know if the rally will end or if there will be new corrections. I don't know. Sometimes predicting a crisis is always difficult. We were able to foresee the real estate bubble bursting in Spain, but when is it going to happen? That's more difficult to tell. So at the end, if this investor had said this in March of last year, the stock exchange was very high back then, and he would have gotten it right, because then there was a crisis. But if he were in a deserted island, he would return 1 year after, and no changes. So I think you need to trust the model. Our model is what it is. It's not a 40-year model like that of Howard Marks or a 60-year-old model, but it is a model that has been tested for 23 years. And we've gone through 3 falls of 50%, and we overcame the maximum level. So we trust this model, and you need to have patience and strength, because the market always requires that for you to withstand in the most difficult moments. Sometimes that value is recognized in a few months, like now, and it's 15% a year, and it takes longer, but it is more stable. So at the end, corrections, just to answer this gentleman's question, if a strong fall comes, we will do what we always do, which is to try to sell what goes up or what less suffers and try to create value buying companies that have suffered more, which is what we did during the correction in March, and it went reasonably well. Along those same lines, sorry, I wanted to add something, just to share what we do. We don't talk about the market because it's not very productive thinking whether it's going to fall or not. I think history has taught us that you have a 50-50 probability, which is like throwing a coin in the air. What we do is to try to look at the trees, and we realize that the forest looks expensive, but we don't think whether the market is going to fall or not, or grow. And if you think about it, for every person who is taking the effort and dedication of analyzing a company like Tubasex, how much is it going to make, who it's competing against, what are its investment plans. For every person who is doing that, there are about 1 million people thinking whether the market is going to go up or down. So it's much more productive to look at companies. There are opportunities in all markets, in bullish markets and bearish markets. In expensive markets, there are cheap companies, like we can see, as we can see in our portfolio. That's what we need to focus on. And in that regard, but the opposite, it says we hear a lot about the change of cycle in commodities. When do you think that change will take place in macroeconomic terms? And are you thinking about another sector apart from commodities with that same potential? Would you like to answer? I think we should clarify that we don't base our investment strategy in predicting huge changes in the cycle. What we do is less exciting, but more efficacious. We observe market prices. We see at how much a commodity is listed, like copper and the copper companies, mining companies, and we study supply, demand, the cost curve, and we try to see what those prices are indicating. And when we think that there's a very low probability, there must be an investment opportunity. When they go up, we sell, and we go on to something else. We sold Freeport, and it continued to go up. Sometimes that happens too. But we don't think, well, now it's going to be a tremendous cycle for commodities, and copper is going to go beyond that price of $7,000, $8,000. It's going to go up to $10,000. That type of thing we don't do. We do a micro analysis. Of course, we have our macro vision too. But its role is a secondary role, and because it complements the micro analysis. And then, yes, if we're looking at other industries, yes, it's what we said. Our work is to think about replacements to improve the portfolio, and we're analyzing lots of sectors and industries.
Well, it's 7:30, and we've been answering questions for an hour and a half. What can you tell us about the big reset in terms of the huge amounts of debt that so many serious investors talk about, like Ray Dalio? Well, he is a macro investor. We aren't. We are more like Peter Lynch, who was a kind of craftsman. Peter Lynch said that if you spend 10 minutes analyzing the economy, you will have wasted 8. So the question is the big reset and the huge amounts of debt. Well, this big reset, well, what I can tell you is that what we think is that in such a complex system as the economy, what we see is that there's a lot of optimism, there's OPVs, valuations are higher than they were historically. So the starting point now seems that there could be a reset. but returns lower than historical levels, I think, should be ruled out. In terms of Mr. Darius' thesis, I don't know them very well, but I have read something, but I would say that we are more akin to the Austrian school, because I would say that in the West, we have anticipated future consumption, and this brings about problems, and politicians don't seem to be willing to make difficult decisions, or decisions which families do have to make, because families don't have any alternatives. When there's no money, well, they need to make decisions. In the West, I am concerned about the decisions that may be made. We will follow up on this. We need to, be watchful and adjust our macro vision in that respect. If governments start doing stupidities with government spending, well, I don't know. We would have to do something. But, well, we're going to change gears a little. There's some questions about the inflation. What is the likelihood that there may be high inflation in the immediate future, in a short term? Well, the question of inflation is there, and we believe that there could be some inflation, but we also imagine scenarios where there is no inflation. This investor is probably thinking about mortgages, and I'm not sure whether there is going to be an high inflation rate, but people that have mortgages and who may be affected by inflation have two doubts. One of them is, the question of variable income, which is normally lower than fixed interest rates. But I would suggest fixed income, because it is a way of making things robust. In our philosophy, we always try and do things in a robust way. So I don't know whether there's going to be inflation, but if the question is because the person has a mortgage, I would lose a little bit now, but go for a fixed interest rate for the long term. Well, we have never had such low interest rates historically. The next question goes even further. It's asking about the risk of hyperinflation. Fernando, would you like to answer this? Well, I think it's very unlikely in the West. Hyperinflation is a highly destructive process. So if there's some minimum institutional rigor and a serious banking class or manufacturing class that can stop politicians, I don't think we will reach that situation. But inflation close to 10% is already very damaging to certain types of investors and to the economy in general. So inflation can start becoming a very serious problem, I would say, from 10%. How can this affect our portfolios? Well, we have assets which... No, but the question was about hyperinflation. So the question is probably about how to protect oneself from inflation. Well, there was an article I read a few years ago which explained what difference existed between Zimbabwe and the Western world. And he said that the countries where the banking class rules, there is never hyperinflation because they will never kill the hen of the golden eggs. Because, a time comes when it is attractive to lower inflation, and it also gives you votes. The next investor takes it for granted that there will be inflation. So he says, given that there is going to be inflation, the question is whether Azvalor can give peace of mind in that context, and how can we protect ourselves from the huge volatility entailed by inflation. Well, we never try and control volatility, because what we try to do is take advantage of volatility, because volatility, is part of our bread and butter. Volatility is very important for us. Now, is Azvalor the right place to be at? Well, we have several things that we have incorporated in our valuations, which I think give people a very good safety net. At this present juncture, for example, we have in the Nasdaq index, there's a lot of companies. Many of them are probably very good, but I have the feeling that many of them have optimistic growth prospects about their profits, and they discount profits at a very low rate, probably correctly so, because the 10-year rate in the US is very low. But in our valuations, we do not include the very high profit growth, and we discount at higher rates than the 10-year rate, which is probably a mistake, and this may have... Well, I don't think that it is a mistake, because the rate is now 1.6, but we invest normally at long term, and I don't think that in 10 years' time it will not be at the level of 1.6. So I think that Azvalor is a place where we calculate value with those very conservative assumptions, which is trying to be conservative with the PE ratio, so the E, when we want, slow rates of growth, and we use higher discount rates than you would get with the 10% rate. Yes, we assume companies that have some debt, we normally assume a higher financing cost than the one they're paying now, just in case. Another question is, I would like to know what is the best way to protect your investment from inflation, and how can this affect the main markets and Spain particularly? Well, the best protection against inflation, I would say, is basically having real assets, raw materials, real estate assets, art, antiques, and if you have debt, you should have debt at fixed rate and long-term debt. These have traditionally been the assets that allow you some protection against inflation. Other assets, well, are different. So I think that that is the best protection against inflation. Real estate, I think that at the beginning could suffer if there was higher inflation, because they were supported by a low interest rate scenario. But inflation is bad for the economy, and it is bad. But now we are told that a little bit of inflation could be good. These are Keynesian theses that I don't agree with very much, because what inflation does is reduce the time horizon of people's preferences and their proneness to invest. It is a hidden tax. It is not neutral, because it produces arbitrary mismatches in the production structure, and it's very bad for markets. And then another protection is not to have any long-term bonds, and it is important to avoid currencies from spendthrift countries, which is difficult. Now, in terms of the evolution of gold, well, they say part of your portfolio is linked to gold. What's your take on the evolution of the gold price in the next 2 or 3 years? The ups and downs. Well, gold is certainly a protection against inflation. It is not the only one. Oil also protects you even more so. according to some people. The thing about gold is that gold mining companies in our portfolio are companies that have improved dramatically. They are much better companies than they were 5 or 6 years ago because of their management, also because they generate lots of profit. They have got rid of their debt and they're as clean as a new pin. But their price is the same as 5 years ago. Barrick Gold has the same price it had 5 years ago. And in the oil sector, well, the situation is very similar. What we do is analyze company by company. I don't know whether the gold price will go up or a lot or a little, but our companies, we have, we really obtain a very good potential. Now let's talk about fees. There's several questions. Given the trend of the industry, many other fund managers are lowering their fees. Are you thinking of lowering fees? Well, would you like to answer this question? Well, yes. Well, in terms of asset management, there's many nuances that need to be considered because on the one hand, there's a new disruption, which is passive management, because saying that, this is related to the reduction of fees. Well, there's no human factor, there's no management per se, there's no human intervention, there's nothing. It's very passive. It's a very big change, and this is something that is happening more and more, where the reality is that where there's no human factor and there's no need for a team to make decisions, then that is one way of managing, which is completely different from active management, which is what we are involved in, where you need an infrastructure, where decisions are made, where you need to have analysts, where you need to have managers, where you need to organize annual conferences to explain what you're doing and why you're making the decisions you're making, as we are trying to explain now. And that is a big difference. And people need to understand what each of the two types of management involve. And then there's general asset managers that have wide ranges of funds, where the main goal of people managing the businesses is to maximize the volume of assets under management, which is a healthy target, that is to maximize the profits of those companies, where in general there's no vocation, there's no what we call this. It is difficult to know, for example, whether any of those managers of those of those companies have their own money in their funds, because and that's something you should watch out for. On the other hand, boutique managers like us, well, for us it's all vocational. We put all our money in our funds. We devote ourselves to our funds, heart and soul, and all our money is tied in our funds. I am part of the executive team of Azvalor, but I am more than anybody interested in the value of our positions going up.
And then among vocational managers, management companies, we have an additional filter, which is limiting assets under management. And that has an impact on our price structure. These gentlemen know better than I do what happens when the volume of assets under management goes beyond a threshold, where the volume is what determines our investments. You can no longer have the freedom to invest. So when we set up this company, we thought that based on the DNA of this company, that entailed some conditions that are well known and that we have never changed, which are accepted by everyone who is part of Azvalor. And lastly, in these quarters that I was very lucky to come across some information published by the Cnnv. It's a quarterly bulletin of the Cnnv with a lot of information. And I was quite surprised when I saw under the chapter asset managers, the average management fee was 139. Well, we got the structure right. And when I looked at the volume there, we were not on our own. There were 25 million euros. We have 4% of that. So there's another 90% of managers that are in agreement with us that that should be the price structure. I don't know if you want to add anything, but that's how I see it. I have very little to add beyond the fact that, well, something you mentioned, our commitment is what makes us different. We pay the same fees. We're in the same boat, and I have nothing else to add. Perhaps Fernando would like to add something. Well, okay, so let's now change the subject and talk about commodities. A couple of questions. Do you think it's likely there's going to be a super cycle of commodities? Are the circumstances right for a structural bullish cycle? Do you think that the appreciation of the value of commodities will continue? Well, super cycle, I don't know. But we know that copper is 4,000 and we sell it at 9,000. So if there's a super cycle and copper goes up to 12,000 and stays there for a long time, well, it might happen. But and if there's something beyond commodities, well, Cinépolis, where we are, this movie theater that we bought. Let's talk about oil. What is your opinion on the peak of supply of world production and its consequences? Do you think that oil scarcity can become chronic? Have we reached the peak oil on the side of supply? And if so, how will that affect investments? And a last one, taking into account the development of new technologies like renewables and all these things, when do you think we should pull out of coal or oil before they suffer a new debacle? Well, there's several questions, yes. The first two, can you repeat the first one? Your opinion on the peak in the world's supply and its consequences, oil. Well, chronic scarcity. I remember that a year ago, they said that there wasn't going to be enough storage capacity for all the crude oil that was in excess. And now we're asked about the scarcity and peak in the supply. Well, we're a bit skeptical of drawing such conclusions. But when we analyze the sector, it was clear for us that we did not share the pessimism there was, and which still continues in the oil industry. And because of things that have happened and are happening on the side of supply. This is the 7th year that we invest in this industry, but very low level of investment. In the last cycle, the investments were 65% lower than those in the previous cycle. So we think the conditions should be met in terms of oil prices that will give incentives to invest, because that investment will be necessary. And our calculation is that to give incentives for that investment, which is already necessary, we need prices of $70 per barrel. We bought companies at $65 that is listed at 5 times profit. So $5 per barrel after a lot of years with very low investments. Well, we have companies that are tremendously cheap. In terms of chronicle scarcity, I don't think there's going to be a chronicle scarcity of oil. The prices will be more or less high, but that's all. A couple of questions on gold. Sorry, it also mentioned, technological disruptions. We talked about it earlier. We analyze it, we follow it, we monitor, but these things have their paces and their impact. And then you have to think about the part of the market it affects. Diesel for cars is 25% of the market. And if you're too optimistic about the penetration of electric cars until 2030, in 2030, we will still have more internal combustion cars. Because if we have 1 billion vehicles, we'll have 1.5 billion in the year 2030. We'll have 1.1, 1.2 of internal combustion. And that affects, because energy efficiency has been playing a role for a very long time, and this is why crude oil had been growing at 1.5%. In a good year, it grew at 2% below the economic growth. That growth in the future will be around 1% is very sound. The fundamentals that lead to the growth of crude oil are very sound and long-lasting. Yes, there were a couple of questions on gold. What are our impressions on the potential evolution of gold? And how do you see the sector the person who's asking says, in view of the fall in the return of treasury bonds, it is expected that inflation might increase, causing a reduction of real rates, which might affect gold. And he doesn't understand why gold has fallen when real rates that are lower could affect it. Well, okay, less negative rates. Okay. We think it's attractive, gold, right now. And in terms of why? Well, there's a very simple ratio, which is the Dow to gold ratio, Dow Jones to gold ratio. It's in the at historical level. I don't know how much is the Dow Jones right now. The ratio, I think, is about 20. Well, I guess it's 30,000, 20 times. In the 70s, it was 2 times. So gold is clearly attractive. Now, compared to oil, it doesn't seem that attractive. If we look at the past 50, 60 years, gold was expensive compared to oil, or the other way around. And then the 10-year tier. Well, the fact that that interest rate goes up can be perceived as, that there's going to be growth, and there might be investment opportunities, and therefore gold is not necessary, and it might have been negatively affected in the past 10 months. But that might be so. But then if there's healthy growth and everything works very well and politicians have calculated things properly and the Fed and everything else, it will be very difficult for gold to gain value. But if there's a slippage and what we have is inflation or more inflation than expected, that would be very good for gold. At the end, you never know if the internal rate of return of the 10-year U.S. bond goes up because things are going to go well, or because there's going to be inflation, or a mix of both. It's a very good and sophisticated question. At the end, what you need to look at are the real interest rates, and subtract inflation. So it would be -1, let's say. But of course, inflation is 2.5 or 2.25. There was a graph, I don't know if we still have that graph, with all the commodities and what they had done or how they had performed. And companies are saying that the cost of everything is going up in these commodity companies. I think there's a bit more inflation than what is published. And that makes real interest rates more negative. So gold is interesting. And if fantastic companies are listed at a very attractive price. Uranium. Several questions. What future do you expect of uranium? Have you sold uranium for a specific reason? Would you like to answer that one? Our vision on uranium, we sold. We haven't sold. We haven't sold this year. Oh, no, we sold. We sold a part. Well, the vision of uranium is that uranium is a necessary metal, and it is a growing market. I think it's 16 countries that are building energy plants, nuclear plants. In the West, this is changing too, because recently there was news that the Biden administration was thinking about prolonging the useful life of American nuclear plants. So they will be consuming uranium. They still have to consume it for many years, but if they extend their the useful life, then they will need more uranium. And then ecologists, activists, more and more realize how important nuclear energy is if we want electricity all over the world without emissions. So the need for uranium is very clear. It's a growing market. And in that regard, there are no doubts. Now, what has happened? That for many years, it's not that we're lacking investments. They have closed capacity with spot prices of uranium at historical lows. And this comes from the Fukushima accident. But we saw that that was unsustainable as uranium mining companies included that pessimism and thought that was going to last for a long time. That was an opportunity for us. And the market started to discount even before, because the spot price of uranium is not like other commodities. But the thing is that it started to reprice, but the shares are already discounting a recovery of the sector. And we've gained, and we've sold a bit where we made a lot of money. In the motor industry, what car manufacturer do you think will be the winner of the electric car in 10 years? Have we analyzed the marijuana sector from the point of view of value? Have you found interesting shares?
Well, we don't know who's going to win the race of the electrical car. The market has given a verdict saying that the winner is Tesla, right? That's what the market has said. Whether that is true or not, well, I would ask people who are better prepared than us to answer that question. The price of Tesla doesn't say much. So I think there are people that are much more qualified than us to answer that question. Now, in terms of the second question was whether you have analyzed marijuana. Well, there is a company called Iberian. I don't know whether it's a quite well-known company that has fallen. Its value has fallen by 2/3, but I haven't analyzed that sector. Okay, now this is Constant Energy. What is the potential of Consol? What about, well, what is the long-term value for this company? What is the potential of this company? And isn't it risky to hold Consol, considering that its price has increased threefold? and considering that, society is moving towards a reduction in carbon. Well, we don't see that this is risky at all. It is true that it has multiplied its value by 3 from minimum levels, but it should multiply by 4 its value to reach its value of 2018, which were maximum levels. So the company is still clearly cheap, and we believe that it is a very good investment opportunity. Now it's $10 per share. It has 34 million shares, and the company is worth $340 million. And this company in 2018 made 260 million free cash flow. In 2016, it made even more. So we believe that at a prudent coal price, it's a company that makes over 200 million free cash flow. So it has not got too much debt. It is the best coal company in the U.S. because it has the best coal mines. It has a wonderful management team. It also has infrastructure that is the Baltimore export terminal on the East Coast, which is wonderful for the export of bulk cargo. And that infrastructure is worth a lot of money. And, of course, and the coal is still going to be with us for many years. And coal-firing plants are still being built by several countries, such as the Philippines. And Consols coal is amongst the least polluting coal, because it has a lot of, because its sulfur content is very low. And these types of coal are gaining market share in international trade because they're more efficient and a little bit more environmental friendly. So there's a few questions on Cameco. As I would like to understand the movements in the shareholding of Cameco. I thought you would stay in this company for longer. I was surprised at the increase in the value of Cameco in the last few weeks because the value of uranium has stayed stable. Other markets discounting an increase in the price of this raw material, and would a rise in inflation favor this company? Well, the first question is why we have sold. We have sold just a little bit of our stake in Cameco because when the share price increases, the risk increases in a non-linear way. The price was 5 in March 2020, and we started. And when we sold at 15, our target was 24. If we hadn't sold, it would account for 13% of the fund. And having so much of Cameco didn't seem too prudent. That's why we decided to sell a little bit to buy stake of other companies. But we still like the company. It still accounts for a significant part of our international fund. And then they were asking about the term price and the spot price, and this is a very sophisticated question because how is it possible for the share price to have gone up if the spot price of uranium was so low? Well, the market price of uranium is not really very significant. The real price is the one paid by electrical companies. So probably, uranium demand will still be there. The sentiment has changed quite a bit since, the broadcasting of that Netflix series called Chernobyl. But having said this, Cameco at 18 is not the same as Cameco at 8. There's a very specific question of somebody on tobacco. I want to understand why you bought into Philip Morris and not Altria. In the case of Altria, in my opinion, in addition to ICOs, well, the potential value of Cronus and Joule are not reflected. Don't you think that Altria would be cheaper and with higher potential? Why don't you buy into Altria instead of Philip Morris, or both of them at least? Or perhaps do you think that the international component of Philip Morris is more interesting than Altria's market? Well, Altria is an interesting company, and we've looked at it, but we haven't bought into it because we thought that price-wise, Philip Morris was more interesting. And British American Tobacco, Philip Morris seems to be cheaper, and that is because we believe there's going to be some growth in that sector. And of course, Philip Morris has a global footprint, and it has got a big leadership, so we feel comfortable with it. In the case of British American Tobacco, perhaps it is less quality, but it is the cheapest of the three. The price is really unbeatable. It's very highly punished for some reason. Okay, let's talk about oil and gas very quickly. What happened with Petrofac? Petrofac, well, there was an investigation from the British Serious Fraud Office. It is an agency like the American Department of Justice. And that investigation, well, they haven't found anything, but it is really damaging the company, and some countries are, quite reluctant to hire them. What we know is that the company has not performed worse than others in the sector, and deep down, this is just 60 basis points at this level, so it's not really. We are reasonably comfortable with the profit-risk ratio. This is a question for Fernando, because you spoke about it last year. What about offshore drillers? We still have drilling, but we have sold some other companies. Well, in diamond, we have lost practically everything. These companies have filed for Chapter 11, and I don't think there's not going to be anything left for the shareholders at the end of the process. Now, the good news, however, is that in spite of the receivership of these companies, we have managed to recoup the previous maximum levels internationally, which confirms the idea that you can obtain profits in spite of mistakes, or even when serious mistakes are made. So I think that this example is interesting to explain something that seems important, which is the difference between a bad result in an investment and a bad process, which is more of a mistake proper. And I have discussed this with Alvaro very often. I think that the process was healthy in this case. And if we went back to 2019 and we didn't know that we would be hit by COVID and at the same time by a price war at the heart of the OPC, then we would go back to buying into these companies, because in 99% of the possible scenarios, these companies would have done well. They would have done very well because they had very good potential. So sometimes, processes are such that, even if you have a healthy situation, the results are bad. Because even if we normally stress investments with the worst scenario, sometimes reality beats fiction, and we hadn't anticipated this scenario, and, we were caught unawares. But in spite of that, for example, in Mills Drilling, which is a company that had a much more solid balance sheet, making money. So this is really a reflection that it should be shared, and we shouldn't lose sight of the fact that even not having calculated what might happen because it was unforeseeable, we, to some extent, do contemplate black swans because we do attribute, we do give these investments a controlled weighting. But when, these things happen, it's inevitable that you suffer. But in terms of Bohr, it is still above water. We have a small position with them. The company has managed to realize 3 capital increases and has adapted its structure, its borrowing structure to the new situation. And it has a series of elements, circumstances, which we believe the financial risk is very high because they have very high debt levels, but we believe that both circumstances are different and the likelihood that it might survive are quite high. Having said this, the weighting is small, and well, specifically it's 40 basis points. Okay, there's several questions about Tullow. Tullow Oil, could it default? Could it restructure its debt? Could it be saved with Brent under $70? Is there going to be a capital increase? Why didn't you enlarge your investment in March 2020? Well, we don't think that there's going to be a default of this company. With Brent price under 70, well, from 55, I would say that the company doesn't run any risk. There could be a capital increase for us. This is not the base scenario. And with respect to buying when it was at minimum levels, I think that the minimum level was 7 pence from 200 in December 2019. And we did buy more shares, not at 7 pence, because there was still a balance sheet risk that made us a little bit uneasy. But Freeport at that time was, a walkover. So it was much more interesting than Tullow, which could have gone bust. But then, the oil price improved, the Ugandan assets were sold, but the company's price didn't increase. So we decided to buy more shares, and until recently, we have been buying Tullow shares. So we still like this company quite a bit. Well, some time ago, you slashed your stake in companies like Transocean, and you haven't gone back to this company when the price was very, very low. Well, when the company was in a distress scenario, there were clearer options.
Buenaventura.
Why has the weight of Buenaventura fallen? Why has its weight fallen? Wasn't it a company with a huge potential when copper prices go up? How do you calculate, or what do you think is its target value? What has happened here? Are you going to increase this position? Well, we find better things. And changing Buenaventura for Tech was the right decision. It's gone up 120%. Now, we haven't sold much, but it was because it performed worse than the rest of the portfolio. I don't think it deserved that. It's a money printing machine with current copper prices. So we're optimistic. With regards to the target price, double to start talking from 80% more onwards. What is the target price that you give to Barrick? I prefer not giving that of companies. In the case of Barrick, it is a company with a better management now and with gold 400 euros higher, so it seems very attractive. Has there been a change in the estimated price of new gold? And after reducing most of your position and taking on a loss, why do you take this position when it was at top prices? No, the weight that was diluted, but when people look at our portfolios and they say they see 3% and then 5%, no, we didn't reduce it. It fell on its own. But what we did was to add, and add a lot when things went better, because you have to think of the long term. With the coming of the new CEO, Adams, was 50, 60, 70. In terms of the potential, we do think it has significant potential, New Gold does. In tankers, the listing hasn't changed very much in the past few years. Why do you think that these shares are going to gain value on the short term? Don't you think there's going to be a permanent loss of value? Yes, we have about 9% of the international portfolio in maritime transport, and tankers is the most important part, but it's not the only one. These businesses are very cyclical. And if you look at a long-term graph, it doesn't seem to follow a clear direction, but they do move. They move a lot. From maximums and minimum levels, they can multiply by 2 or fall to half the value, so they do move. And the key here is to buy them at the right moment of the cycle, buy cheap, which is the present moment right now. Buy them cheap and then buy companies that make good investment decisions and companies that have enough balance sheet to go through bad times, because what is unpredictable is how much the low cycle is going to last and when they will recover business. But we don't think it's a permanent loss, no. DHT and Aeronav, ever since we bought, they paid 10% return on dividend. So in there, they have a very comfortable balance sheet. And they bought at very attractive prices, so the value per share of the companies has improved. And to prove that things do happen, we had companies, or have companies, in dry bulk transport, where we made 75% in dry bulk. So they can go up in a lot. Like Mako, that went up in 6 months, the equivalent of 4 years. Freeport, why did you sell so soon? Because of sustainable energies, you were expecting copper prices to go up, and that increase is happening now. Yes, we sold at 30, and it went up to 37. So this investor is right. We sold too soon. We sold at 30, but we invested in Cnnv, whose value doubled. Yes, that last increase, we're not there to catch that because we feel like buying something else that we know well and that has fallen more. Yes, another question. Will we have in the short term 2-digit returns? And I say short term because long term, those of us who have been here from the beginning, it's already passed. Well, I think we have mentioned this several times. The market sometimes it takes a long time, and then it recognizes the value all of a sudden. Because of what we've been saying, the process has to be right. We have to know how to calculate the value of companies, and the return finally comes. It isn't normal what the situation at present, because we've gone through this huge crisis. That's not normal. It's not normal that people who joined this year made 100% in just a few months. That's not normal either. The normal is the long term. And we made historically 4 or 5 points more than the stock exchange. So the key is having the confidence, the strength, and the patience to withstand those moments. And this has been a long moment for everyone who is in the world of value. Several questions on yields. The trend has turned around, and it's a bullish trend right now, isn't it? I don't know. As we said on several occasions, after such important drops, the market can stay there for a long time. Do you take into account historical error of 10 or 15% of values, taking into account those mistakes when you create the target value? That's a very interesting question. No, we don't take it into account. In other words, if our target price, it's calculated as the target price of every company that generates an upside vis-a-vis today's price, and you multiply for the weight. So this client has made a very interesting remark. How do you measure, or how do you factor in the error? Because a 15% error rate doesn't mean that it's going to go to zero. It would be difficult how to factor it in the target price. I'm thinking about situations where we've made a mistake. I'm thinking of a company where we realized there was something we didn't like, and we made 75%, and we sold it. How do you factor in that error? Because other people work, and the team that we work so many hours, and you realize several things. For example, Fernando's presentation about liquidity, it's interesting because liquidity, if you realize that you've made a mistake on something, you can change. Like Miller said, somebody who made 30% a year for many years. Well, think about it. How could we factor in the error in the target price? And sometimes the error is that the target price is higher than what we thought. What happens if freight of tankers start to go up, and they give us a dividend? Because sometimes we also increase a target price. One offsets the other. And perhaps, yes, there might be a 3 or 4% residue. We might be able to eliminate that. See, well, think about it. It's an interesting question. And a clarification, we're talking about 10 or 15% of cases, not of money, of cases. Yes. We always have the hope not to make the same mistake again. Yes, in a company, we try to avoid any mistake, any error. But sometimes we realize on time. Yes, but then I think it's interesting what you're saying. Because if you say, I'm not going to make any mistakes, you won't make them. But like Howard Marks says, if there's a dollar bill on the floor and there's a lizard, you go and pick up. If it's a crocodile, you don't bend down to pick it up. So investments that are easy are usually risky. You can lower the error rate, never buying a company that has any debt and that is perfect, but you won't get a return, and that is also a risk. Not getting a return when there's an accessible return, as Howard Marks says in his book, The Most Important Risk. There are many types of risk, and an important risk is not getting a return when it's there to be made. And I'm thinking of some investors that have a lot of money in long-term bonds. They say they'll fall, and when the prices fall, I'll go in cheaper. Yes, maybe, and it has been like that, but not always. A very interesting question. With time, the assumptions of gold and uranium have been met, also with gold. So, and the others are also going well, like uranium. So what do you think will happen? Yes, in 5 years, it's not satisfactory return. We've said it several times that the potential of the fund is 100%. Gold, and we sold higher, and then we bought back with the drop in the past few months. Uranium is not depleted yet. We have coal. We have lots of potential. And then our daily work, our day-to-day work in trying to improve the target value, finding ideas, taking advantage of volatility. So, but this investor is relating, oil has gone up what it had to go up, and the portfolio hasn't gone up. Well, oil companies went up 90% since the vaccine that was announced after the elections. But the oil services index is 70% below what it was. The market doesn't believe the increase because the forward curve is not where the spot curve is. And then everything you said, too, I agree with. And although you've already answered in part what sectors are going to generate the future profitability when commodities are already at the right price. Well, uranium still has potential. Gold mining companies were at the level of when gold was 1,300, and now it's at 1,700. So there's still a lot of potential in commodities. And we have very important things in the pipeline. It goes, something goes up 4%, you buy, you sell, and then you buy something cheaper. Why does the S&P, why does it evolve in a different way than the index? Well, Geopark, for example, is a company that went very well. Now, the pension fund that benefited recently also suffered from the fact that we invested more in Epsilon and Consol than the way we had in the international fund. Those investments are still there. Now they're doing better. And this is why that fund is better than the international fund. But it's small. It's a small fund. So if we can help it with a small cap company that we cannot include in the international fund, then we do so. What is going to be the strategy once target prices of these companies have been reached? Remain in that sector or go to another sector? Well, we already have gone into a different sector right here. We are in a movie theater. We bought this movie theater, so we're already doing that. But we're still invested in coal, tankers, etc.
This is something that people keep asking. I'm a new participant since January. Do you consider the international portfolio still to be cheap? Do you think it is likely that it will still contribute value? Well, I think we have mentioned it before. The revaluation we achieved is because we come from minimum levels, and we do believe that there is considerable upside. So, yes, there's no doubt. And people who started in 2004 already had 100%, and they won another 100% in 2007. People who invested at minimum levels in 2009 and 100% by 2012, and then in the next 2 years made another 100%. So this upside has already been obtained twice. What turnover is there in the portfolios every 12 months? Well, not much turnover in terms of names, but there is a lot of turnover in terms of value, especially this year because there's been significant spikes, especially uranium. The price of uranium increased fivefold. But in terms of names, the turnover is not very high, because for a company to be included, it has to go through different tests. But every day we tend to, sell what goes up and buy what goes down. Until now, value funds have been punished. It seems that there's going to be a change in cycle. How long will it take for value to become equal to performance? Well, we have answered this question, I think. How long could it last? Well, that's a question that has no answer. Sometimes we have given examples. We have a potential of 100%, and it could be achieved within 5 years, to be conservative, which would be a profitability of 15% a year over a 5-year period. After a period where we did worse than the indices, perhaps things could be faster. And this has happened in the past, but this is something that we can't really answer. You can't really tell. This is another. So, do you think that the ways in which people invest could change in the same way as young people don't watch television anymore? Well, it is happening already. The way people invest is already changing. Growth has triumphed over value. And Katie Woods has become a very famous person. She's the one that manages the ARC funds. So have we grown too old? Well, I don't know. Well, Fernando and I were teachers at one point. I started in 1999, and I'm still in touch with many students. I don't think that young people can see things you can't see. Of course, it has happened, but there's no reason why that should happen. Of course, young people, of course, it was hard for us to understand Amazon or, So it is true that young people, can see things that, you can't. But seeing the world through YouTube is related to something different. YouTube, has tuned into people's preferences and has changed things forever. But if you switch to growth, that cannot be a fad, because the stock market and the market, if prices keep going up, a time will come when profits will be demanded, and if the profits are not there, things may go sour. Somebody was saying recently that there's approximately 300 companies at present which are worth than 1 billion and which lose money. The fact that they lose money doesn't mean that they are a disaster, because intangible assets are such that very often a good business may apparently generate losses. A company may spend $2 capturing a customer, and if that customer is going to give them 10 throughout their lives, well, that is not always the case. So for companies to lose money is not negative, but for there to be 300 companies which are worth more than $1 billion and lose money, well, and I don't think that all of them will become the next Amazon. Some of them may, but it's not easy to become Amazon, Google, Facebook, or Netflix. So I have the feeling that some damage will be caused, and of course, there may be some companies we don't understand because we've grown too old, but in other cases, I think that those companies are a real disaster. And chapter 3 of the book, devoted to Irving Kahn, who died at the age of 110, one of the chapters is called A Centenary Diet. What can we expect from the fund for the next years? We have answered that question. What about the moats of companies in the digital environment where there's problems with the revaluation? Well, could you ask the question again? Well, moats. How would you analyze the moats of companies in the digital environment where the traditional parameters do not reflect the whole revaluation potential of those companies? Well, we have just talked about that. This is a very good question, because at the end of the day, you can't use PER to assess a new company with a moat potential vis-à-vis the digital competition, and this is undeniable. You can't do that. We, as a generalist investment company, and this is, I'm not being too humble here, I think that we are at a disadvantage here because there's an essential part if you want to invest in these companies is you need to know how long the franchise will last. A customer that you spend 2 to capture, but then it gives you 8 and $1 every year, etc. So, you need to retain that customer for a long time. And that technically, appraising the duration of the franchise, 15 years, 20 years, 25 years, is not easy. So, that is more difficult than it seems. Now it seems easy to say that Amazon customers will last for a long time. But how long are the customers of each software company? Well, it's difficult to tell, because many other companies are working very hard in that sector to take those customers away. So in our sector, we think that we have a disadvantage to value the duration of those moats. So if we have a disadvantage, perhaps it's best not to enter those sectors, and that's why we, stick to, what is best known to us. There's a theoretical question on value investing. Even if a company can be valued below its target price, and its revaluation is a question of time, is there a possibility that a technological disruption may sink the company before the value surfaces? That's a very good question. And the answer is yes. This customer has defined what we call a value trap, when the profits of a company plummet permanently. And we have talked about newspapers and the migration of classified ads to the internet. A company may be very cheap, but if there's a new technology that competes with it, then the company will never go back to making so much money as it did. So this is something that could theoretically happen. In the portfolio we have at present, we know that we believe that the disruptor potential is low. And in the bench, there are companies which we have stopped looking at because we're not sure. There's a company that perhaps you know about, which is called Rexel. The value fell a lot, but there's a disruption. risk that is not very high, but it does exist. And, so we didn't want to pay more than a certain price precisely, because there was the risk of that disruption. So we are very respectful of disruptions. There's a question about how we appraise that risk in our companies. Well, in our companies, in our portfolio, how to assess the risk that this may happen. But I think you have answered this question already. Yeah, it's what we've said. We try and analyze things and understand them. If we can't see a clear picture, then we just don't invest. I will read the question again. How do you value the risk that a technological disruption may turn companies on your radar obsolete in the medium term? I think he's asking about the competition circle. That is, he's asking, about the possibility that we may not find something similar ever. I think that was the question rather than, because it's happened to us before. There are people that say that we might become obsolete in our own competence circle. If that is the question, then of course there is an aspect. Calculating the duration of digital franchises is something that we don't even try to do, because it would be a waste of time. But we do lots of things as human beings. We get up, we have a shower. All of those are sectors. I don't think that we have become obsolete across all the different sectors of the economy. There may be some sectors that we don't understand, and those sectors may affect more areas than just the technological areas, because technology is very much related with consumption. And there's also, we don't invest that's why we didn't invest in Rexel, and for that reason, many healthcare companies, we tend to shy away from them because they may be disrupted by Amazon. Insurance too. So there's many sectors where there may be disruptions, and in some of them we believe that we can understand them, such as insurance, but in others we believe it is more difficult. But I don't think we will be left without any companies to invest in. Fernando, I was going to answer precisely that. We try and analyze companies, and it is legitimate to think that little by little our competence circle is shrinking, but we are extending to other areas. Fortunately, the economy is extremely rich, extremely varied, and there's still a lot of sectors that we, can learn about and invest in them. But it is true that this keeps happening, but we are clear that when we are not sure, we don't invest. Not making money doesn't mean that you lose money. A couple of questions on volatility. Are you satisfied with the volatility you have? The risk-reward ratio has been satisfactory in your view? Well, volatility, we don't try and control it, because volatility is what gives us opportunities. There is a study, a colleague published something, and then I read another article which says the same thing in a simpler way. He says that 40% of companies that have ever existed on the Russell 3000 have fallen by 70% and never recovered. And they also say that 90% of companies in Russell 3000, every company in Russell 3000 have been doing it individually worse than the index 2/3 of the time. So, and that is the conclusion reached by the study mentioned by Javier. So since they measure things point to point, it means that it's 70% of the time, it's 4 days out of 5 working days. So 4 days out of 5 working days, you go to bed, angry. with what your shares did. And that is the definition of the game. If a customer says, I want to avoid volatility, well, it is impossible. You can avoid volatility buying a 30-year bond, which in 6 months lost a lot of profitability. So volatility is the name of the game, and that is what allows us to, thrive. And clearly, when people speak about reducing volatility, it's because they don't understand. Yeah, it's like fighting against windmills. Volatility is the price you have to pay for having daily liquidity. Volatility, then you have to invest in private equity or other things, but I don't know of any market where you have daily liquidity and there's no volatility. You can't have both things. You can't have your cake and eat it. What is important is to know, to harness volatility and not be a victim of it.
He interprets it as a risk, and you see it as an opportunity. Yes, sorry if I insist. Would it be possible to reduce volatility by just a bit? Well, there's a wish for peace, that comfort, right? Peace of mind. Regulations and disruptions. Is there a possibility that excessive regulation that wishes to weaken the leadership of a company might end up strengthening it because it would create barriers of entry for its competitors? For example, Facebook faced regulations and trials that made it comply with additional standards. Far from having an impact on its earnings, have established new barriers of entry for potential competitors. So regulation, instead of attacking it, it has strengthened it. Very good point from this client, very sophisticated. And he has a point. The stress through regulations, very aggressive regulations, stress strengthens you as a company. If it doesn't kill you, that's an interesting nuance. If something doesn't kill you, it makes you stronger, as the saying says. In the case of Facebook, I don't know. We're not experts in this company. But what I see in our management world, I was thinking about this because I think he has a very good point. In our world of management, what we do see is an increase in barriers of entry because of regulations. Sergio knows this well. Compliance, reporting. I'm sure that Sergio's team meets all these requirements extraordinarily well. That makes us stronger, and it increases barriers of entry. I don't know if in this case this is good, because the more small management companies can exist and grow, the more choice there is for investors. But very good point. And within this universe of questions, they ask about prices of technological companies, Amazon, Google. One of the best businesses that there has been in humanity, businesses that grow a great deal, businesses that are not capital intensive. Fortunately, we were able to invest an important part in significant amount in Google when it was going up so much. But right now, the multiples I don't think are excessive. If the profit, the part of the A, remains for many years. The duration of the franchise, we don't know about that. In the case of Facebook, Google, Amazon, I don't know. Fernando, perhaps you have a different opinion. No. An asset that is very much a fad, Bitcoin. Can you give us your opinion on cryptocurrencies and non-fungible tokens? Do you think that the Bitcoin can replace all gold? Are you going to add Bitcoin to your portfolios as Incrementum does? Well, we are investors in companies. We're experts in valuing companies. This is something quite different. In terms of, will it replace gold? Well, time is in favor of gold. 5,000 years, shining as a value reserve. I don't know, Fernando. I don't have much more to say than the 5,000 years of gold. There are things that might escape us, but what we do is analyze companies. This is why they talk about incrementum. They mention increment. Yes, incrementum produces an annual paper, which is very good, and we follow. It's very good paper. I guess there are many people who buy to see what happens. But I insist, there are things that are in our circle of competencies and others are not. I prefer to be prudent. Yes, just to add something. It aspires to turn into money, and perhaps it will succeed. But it is one of the most important institutions that exist. And it came up spontaneously, and I think it has a lot of human progress. I mean, it's quite something to turn into money. And if it turns into something like money, it's quite an achievement. Another investor, followers of the Austrian school, is it possible that you might have curiosity about the world of Bitcoin? Are you thinking about investing in Bitcoin directly or through other companies? No. I don't know. Yes, we're curious. We have curiosity, yes, for the reason I said, because it aspires to turn into money. But to answer your question, or the question, no, we're not thinking of investing in Bitcoins. We leave that to the experts. Okay, we're coming to the end. Errors in 2020. Several questions on that. Sorry? A couple of questions. Errors, mistakes. The three main errors you made in 2020. Well, as I said earlier, we changed a few things in the way we manage the company, little things, really. But mistakes made in 2020, I think the greatest mistake was in that very difficult situation where Beltran and you or your team couldn't access people. We were in a lockdown, and we weren't able to be closer to our investors who could not withstand the pressure. We tried, but we did not succeed. Well, we did succeed, but not with some of them. So the shepherd leaves following the sheep that gets lost, but leaves behind the other 99 sheep. So, well, that's, we couldn't be there for everyone, but I don't think we've made any serious mistakes in 2020 in terms of investment. It was a very benign year. When we see things very clearly, that is when we see more doubts around us. Sometimes we get calls. Most of them stayed with us, but they asked, do you have to sell? Will this be a moment to sell? No, it's a moment to buy. Yes. Yes, some of them, when something close to them says, I cannot afford losing any more money, and we tell them, no, you haven't lost anything. Well, no, I want to sell. We could do things better, but the Merrill Lynch investors never made the returns that Malaya did. Some people can stand the pressure, others cannot. And those people are not stupid, no. They're doing what our brain is used to. When you see a fire, run. So there's a point in that. But in the stock exchange business, if you always want to save your life, well, you perhaps won't take advantage of all the opportunities. It's 9 o'clock. One more question. Yes, a very easy one. What is the limit of the size of our funds? The limit for closing. We've said it several times. And then lessons that you learned from investments. It's actually things that you've already answered, and a couple on ESD, and we'll have to leave some out. What do you think about the current world? Decisions are not made by economic analysis only, but ecological criteria are growing in importance. So who else we can pay? I don't think if the whole world is going to become California, but about ESG, would you like to say something? Yes. Financial decisions are made that don't take into account return criteria. A long time ago, the chairman of CEPI said that sustainability has to be profitable, and profitability has to be sustainable. Any investment decision that does not take into account return on the long term, I don't think can succeed. I remind you that sustainability is 3 pillars: environment, social aspects, and one that is very important for many companies and to make investment decisions, which is corporate governance. Align the interests between the different investments. Align the 3 pillars. That, I think, is very relevant to make investment decisions. And the last one is, why do you think that in the world of management, there are hardly any women? I don't know. I never thought about it. In the analysis teams and management teams, there are few women. There are women in other departments. For example, the head of the back office is a woman, the head of risks. But yes, it is very curious because in other more generalist management companies, there are women in the management teams. There are very good companies in Spain led by women. But the fact that we don't have them in Azvalor doesn't mean that we couldn't have some. Kathy Wood, you mentioned. She's very important right now in the world of management. Yes, she has become very famous. Fine. I lost one along the way. One more? No, I can't find it. Okay, so I think this is the right time to close. It's almost 9 o'clock. What a shame that we couldn't see you in person this time and greet you as we do every year. I hope that next year we can do it in person. Thank you so much for your patience, and we'll see you next year. Fine, thank you very much.